Good afternoon, good evening, or good morning, depending on from where you are joining us today. My name is Julie Katzman, and I'd like to welcome you to this panel discussion on alternative financing for decarbonizing cement, which is a great follow-on to Lillian and Marek's presentation. As a non-professional cement person, when I told my friends that I was going to be moderating a panel for the World Cement Association Annual Conference, they all looked at me a little bit oddly. Cement. That was until I started talking to them about the impact that cement has on our environment, on climate, not only from the perspective that has been much discussed already today, which is the carbon in the production process, but also the effect that increasingly impermeable, dark, hard surfaces are having in our ever more urbanizing world, from heat islands and the increased use of air conditioning to increased flooding and the inequities in city temperatures. We have three great panelists today with a wide range of backgrounds to speak about this in concrete terms. Sorry, I just couldn't resist. About financing opportunities and dimensions around cement and cement assets. And as a reminder, we will be reserving some time at the end to take questions, so please do put them in the chat. Let me start with Eric Trusiewicz. Eric comes at this with a deep background in the industry itself and has combined that with venture capital and entrepreneurial experience. Eric, maybe you could start us off by talking a little bit about what the demand side looks like. Is there a serious appetite in the VC community to finance decarbonization technologies when it comes to cement? Have there been successes to date in the pilot phase or beyond? Give us a little bit of a sketch of the background there.
Sure. Thanks, Julie. I would say there's an absolutely enormous appetite for these kind of things. And I think that that's changed in the venture world. You know, a few years ago, it would have been very difficult to find venture capital investors who are interested in cement and concrete decarbonization. But I think a few things have changed. One, regulatory attention has shifted from the energy sector to the heavy industrial and hard to decarbonize sectors. Two, you've seen a lot more pricing of CO2 and a lot more evidence that emissions of CO2 outside the European Union, may have a price on it in the future. And I think three, you've just seen kind of an emergence, a re-emergence of clean tech investing as a general category. And those things have led to people looking for different investment theses. And i.e., 3 years ago, would have been surprised to receive any kind of phone call about a cement or concrete decarbonization startup. And now it's very, very common. There's huge number of startups which are proliferating, huge number of funds at all different parts of the capital stack that are interested in this sector, and then there's technologies of different maturity that are really either being developed or coming to fruition. So yeah, I think there's a very large appetite for that.
Does the structure of the industry put off any of the venture money that's out there? I mean, we've all seen examples of oligopolistic market structures where innovations have a hard time getting broad adoption. Has that factored in at all, do you think, in the demand that venture capitalists have around investing in this sector?
I think one of the primary barriers does figure into calculation around, investors' appetite. And that's really, if you're producing something which is not exactly cement, but functions like cement. So if you produce a magnesium-based binder or a novel supplemental cementitious material, or a new type of binder which works well, but is not actually ordinary Portland cement or very similar or analogous to ordinary Portland cement or another existing supplemental cementitious material, that raises a lot of concerns because there's a whole web of regulation meant to protect public safety around a cement utilization in structures. And very rightly, people understand that there's hundreds of millions of people working in the construction sector who need to use this material. The public safety, with buildings or whatever structure, transportation infrastructure, et cetera, is something that's at risk if you change the material, and that material change cycle actually takes quite a long time. So I would say that definitely plays, that regulatory aspect definitely plays into what investors are a little bit scared of, the timelines around that regulatory change.
Yeah, that makes a lot of sense. You talked a little bit about the capital stack and people being present in all parts of the capital stack. Are there any particular structures that are, no-goes or that are particularly appealing that are not unique to these kinds of opportunities, but perhaps more prevalent in?
Structures, you mean investing structures, or what?
Yes.
What kind of structures?
Yes, investing structures or terms.
I don't know. I mean, I think that the structures for investing in early stage technologies are usually pretty standard. Maybe the novel aspect of clean tech investing in general is that very quickly you get to need a large amount of capital risk equity for pilot projects, and those pilot projects are in the tens of millions, or even potentially more sometimes. But it's a very risky part of the investor stack to say who invests in the first of a kind industrial scale, or first of a kind, a pre-industrial scale entity. So if it's a physical asset, but I think that's not specific only to cement. That's a problem that's kind of endemic to a lot of clean tech sectors, where it is real asset based technology, and you can't really know, does that technology work until you put a bunch of steel and cement and the technology in the ground and try to operate it. And that's a little bit more difficult segment of a clean tech or segment of venture capital than investment into digital where things are a lot more asset light.
So I'll use this question as a bridge to both you, Eric, and Lewis, who's at SYSTEMIQ Capital. Are you seeing appetite for those larger investments to get to a plant scale, full-on production facility? And are you seeing any activity in the philanthropic sector to complement the venture sector to de-risk some of these projects, for example?
Yeah. Is that question for me or for Lewis?
It's for you, and I was warning Lewis I might ask him if he has a perspective
Sure.
to jump in. He's going to come in later on something else, but if he has a perspective on this, to feel free.
Yeah. Yeah, I think that there's more and more interest higher in the capital stack amongst growth investors, private equity investors, sovereign wealth investors. So, I think there is additional, I do see a lot of interest. Philanthropic, I get the sense that there is interest in philanthropic sectors, but there's a lot of difficulty understanding the technologies in that sector, because I think oftentimes philanthropic donors don't have access to a lot of technical resources. So in venture capital also, there's some of the funds have more technical personnel than others, but in philanthropic, they don't generally have a lot of technical understanding of the sector. So it's difficult for philanthropists, I think, to identify what are the things that they can support and what are the some of the most fundamental technologies. I think one of the most promising efforts and technologies globally looking for philanthropic support is the LC3 project from EPFL, which is very concentrated on bringing calcined clay or limestone calcined clay cement to the developing world. And I know any philanthropists who are looking at the sector, that's something that they should look at too. But I think it's difficult for them to identify amongst all the proliferated technologies and different actors what is the right one to support in general. So
sure. Lewis, do you have anything you want to add to that?
I agree with Eric. I think the philanthropic money mostly comes in from what we've seen as very early stage, so to de-risk the very beginning of the pathway. People like the Grantham Foundation, for example. Less so at later stage, but yeah, we do see a lot of appetites for later stage money, which gives us early stage funds a lot more confidence to invest as well, because we know that there's going to be these hundreds of millions of dollars required to really scale up the solution later.
Super, super. So with that, let me transition to Francois Millet, who is the head of ETF strategy, ESG, and innovation at Lyxor ETF. Francois comes to this discussion with a wealth of knowledge in the public markets around sustainable finance, having been involved and having designed what I'll call many of the firsts in this area, from the first green bond ETF to the first global gender equality ETF, and the first range of ETFs which are tracking the EU's climate benchmarks. Thanks for joining us, Francois. I asked Eric to start talking a little bit about demand, so I'll ask you to also start with a little bit about the demand side. Can you tell us about the trends that you're seeing in the pools of assets today in terms of their shift towards sustainability, and collaterally a shift away from carbon heavy investments? Is this accelerating faster or slower than you would have anticipated? And how can you put some size around that for everyone?
Sure. So thanks for your question, Julie. So I will give the perspective of listed markets, of course, through the lens of the ETF market. So the ETF market, it's close to $10 trillion. It's the fastest growing segment of investment management. So it's a good barometer of the flows. It's known for that. It's a 20% growth per annum in terms of assets. So effectively, what we're seeing in our market is that ESG is not a trend, it's a transformation of the portfolio. 2021 will be another year of record flows, beating 2019 from that perspective, for all funds which are promoting environmental, social, or governance characteristics. And if we look at the perspective of the European investors, which I am more representing, well, the US market is 4 times the size of the European market, but still, this is in the European market that you have the most assets in ESG ETFs. So still dominating in Europe, and the new ideas, the new trends are still, for the time being, I don't think it will last very long, coming out from Europe, as the United States is catching up. So the new money is effectively going to new strategies which are going much beyond the traditional ESG filtered or ESG screened strategies. They are now going to more and more to climate aligned portfolios, which is a new concept. It's not about doing best-in-class selection according to ESG rating. It's more looking for portfolios which are aligned with certain given targets of warming potential, and generally looking for aligning with the objectives of the Paris Agreement, like below 2 degrees or 1.5 degrees. From that perspective, we see that the material sector, which is already not very highly represented in the traditional markets or indexations. For example, material sector is something like 4.5% of the MSCI World Index. We see that in the climate indexes, effectively, the material sector, which is comprising the cement sector, of course, has a tendency to be even underweighted, something like below 1%. So yes, we see a shift of allocation because these portfolios are not diversification portfolios. Their philosophy is to push to reallocate capital at scale in the core allocation, not as a diversification. So, for example, today in Europe, we see that 49% of the net new assets, which are very substantial in the ETF market, are going to ESG strategies. More than 10% of these ESG new assets are going to the new climate strategies. That's very new because that started just 1 year ago. So it's a very strong trend for new money, going now more to climate investing than just ESG filtering. And I should mention as well in the trends that we see a booming demand out of Europe on green bonds through the ETF market, but also in the primary market of green bonds, which is driven now by the emergence of a very strong not only corporate sector, but sovereign segment. And we see there that the material sector and the cement sector is not represented or very underrepresented because they do not really provide the sort of projects and assets eligible to the taxonomies of green bond issuances. So they are, in a way, for the time being, missing this opportunity in terms of raising assets from the market. But we might see more and more of companies of the material sector tapping the transition bond segment now, which is growing and which is in fact even more impactful than the traditional green bond sector, because it's all about transitioning former installations that are highly carbon intensive to lower carbon intensity ones. So we see a lot of appetite for that out of Europe, for example.
So, you know, that's interesting when you talk about the materials and cement sector being underrepresented and it sort of it's missing the taxonomy. This sector, though, actually has a pretty good handle, and I'm thinking about the Holcim green bond for a minute, has a pretty good handle on, and it's relatively simple to measure, in fact, its carbon impact. So, you know, in a way that's a little bit counterintuitive. I would think that the cement companies would have a big opportunity to use those metrics to structure bonds that could be very interesting to the market. Why is there that disconnect, do you think?
That's why I was mentioning the new segment of the bond market opening, which is transition bonds, which is more corresponding to the materials company. Because today we have no real green bonds from the cement industry outstanding in the market. The corporates, which are highly carbon intensive, which are massively tapping the green bond market, are electrical utilities. This is the first sector in the non-financial corporates, but we do not see materials yet because the taxonomies which are defining the assets and the projects which are eligible are not necessarily covering in industry the right areas for the time being.
And the definitions that either have been or are being developed in the transition bond market, have or you think will have the taxonomies that allow for the material sector to be bigger participants?
I think investors are in this segment of the market more willing to be agnostic about the global business of the company and looking at their transition. And in fact, something has changed over the last 12 months. What has changed is that a large number of investors are now setting their own net zero targets. So they need to find investment opportunities which are contributing to the reduction of the future carbon emissions of their own portfolios. And second, in Europe in particular, they are submitted to very stringent new regulation, a disclosure regulation, a taxonomy regulation, a benchmark regulation when they are managing ESG portfolios, which are pushing them to report new indicators like the green share of their portfolio, which itself needs to be calculated according to the quantitative and qualitative criteria of the taxonomy. So these changes are making that, investors are looking for investments which are able to report the emissions avoided or the contribution to the decrease of the emissions of their own portfolios going forward, and not anymore looking backward at the carbon footprint of the issuer. So more and more, the construction of the portfolios is leaning towards tracking the contribution to the reduction of future emissions of their portfolio. And from that perspective, this should also include sectors which are more carbon intensive, of course, because we all know that cement is something like 7 or 8% of greenhouse gas emissions and still underrepresenting in portfolios, in illicit portfolios.
Well, it sounds like there's a lot of opportunity there, and I would say the so-called greeniums from those issuers who are in the green bond market, they're able to place bonds at a premium, lowering their overall cost. Can you just give people a little bit of a sense of how many basis points that can be?
Sure. So the greenium is something very symbolic because it's showing that there is a huge demand on green bonds from all institutions in Europe, both UK, continental Europe in particular. We see that on sovereign issuances very clearly, like the German ones, the latest Italian one, but we see that also for non-financial corporate issuances, in particular, the large electrical utilities like Iberdrola or Engie, or even US issuers, like even the Walmart green bond, which was issued 1 month ago, a big one, it was $2 billion, was issued at a greenium. But what we are seeing is that after the book building period, generally investors are accepting a sort of concession on yield of a couple basis points, like 2-3 basis points. Sometimes this gap is increasing a bit in the secondary market. For example, for the German sovereign issuances, we have greeniums of up to 7 basis points, whereby we see that investors, because these new bonds are fulfilling another utility function in the portfolio, which is precisely helping them to calculate the contribution to the carbon the carbon emission reduction. They are prepared to pay a bit more and receive a bit less of yield to maturity for such instruments. So the demand is definitely extremely strong.
Last question on this front, which is, there's been a lot of discussion around greenwashing and impact washing, really. And I sort of consider it somewhat like the organic food phenomenon, where people slapped the label organic on everything until there was effective regulation. If you look at investment products being marketed today, pretty much, almost everything you look at says ESG. If you dig under the top there, you see that actually there are fossil fuel companies in some of these portfolios. How do you see the timeline around effective regulation or distinguishing amongst these various products, so people can really know that when they put their money in something that they think will be climate positive, it really is?
Well, I think that the emergence of voluntary disclosure schemes, which are becoming standards, is putting a lot of pressure on issuers, even if they are not compulsory. And on top of that, we have the emergence now of compulsory disclosure schemes in certain regions of the world, in certain jurisdictions, like the European Union, for example, with the corporate sustainability disclosure regulation directive. So yes, we see a combination of both. We see effectively that greenwashing has a tendency and a risk to increase, because everyone is now talking about net zero, for example, and there is no single definition of net zero. From one company to the other, you see that some are making more or less use of, compensation of renewable energy purchasing, contractual agreements, of investment into voluntary emission reduction certificates. Some are only acting on their scope 1 and their scope 2. Some are really trying to lobby and put pressure on their own clients to decrease the scope 3 emissions on the use of the products that they are selling. But from one company to the other, we see that the pathway to net zero is extremely different in terms of definition. So net zero is in every mouth, but covering very different realities. We will certainly need some convergence in definition to fight greenwashing in that area. But that's the same for governments, that's the same for investors in a way. So in some areas of the world, like Europe, we have a package of regulation which are extremely structuring for investment, like the disclosure regulation, which started to enter into force in March and which will be even more on the agenda next year. The taxonomy regulation, which is defining the economic activities which are contributing significantly to climate change mitigation, climate change adaptation, and other environmental objectives without harming the other objectives, and the benchmark regulation, which is in fact designed to help reallocate capital at scale, but also fight greenwashing and allow comparability between the actively managed or the passively managed index-based climate-aligned strategies. For example, the European Union has designed indexes called the climate transition benchmarks and Paris-aligned benchmark, with an extremely prescriptive frameworks, which is itself very much science-based, like, for example, a 7% year-on-year decarbonization trajectory over the lifetime of your fund and so on. So these regulations are setting quite a lot of standards, of course, on the way also to calculate things like I don't know, your intensity in carbon should be using scope 1 plus scope 2 plus scope 3 with a phasing period according to the sectors. You should calculate your intensity on the enterprise value. So we give an example in a large area.
We're moving in the right. We're moving in the right direction with a lot more.
Especially in the area of climate aligned investment, not for ESG, because ESG, there are thousands of ways to combine, the different KPIs, but for climate investing, it's converging.
Super. So I'll shift to Louis. And having heard a lot about the financial resources available in this transition from Eric and Francois, there's also financial risk, everything from a loss of competitiveness as competitors perhaps transition much more quickly than others, to lower carbon cements, to stranded assets. Louis is a senior associate at SYSTEMIQ Capital and focuses on climate restoration and decarbonization in fact, hard to abate sectors like cement, as we know. So, some might think it odd to ask someone at a venture fund to talk about stranded assets. But in effect, isn't it the job of the venture investor to fund the breakthroughs that strand those assets? Louis.
I mean, to some extent, yes, innovation can be disruptive and sometimes that can strand assets. I would say that it's never the prime objective, right, to strand assets actively. Sometimes maybe coal might be a case, but definitely not for cement. And actually, the way we look for innovations in the case of cement is mostly by looking how compatible they are with the existing capital stock, because in cement, the assets are rather old, rather stable. And so there's if you find an innovator that wants to strand the assets of the cement industry, most likely they will die in this, and the assets won't be stranded. So yeah, that might be our job, to look for things that will accelerate the transition of those assets rather than their stranding.
Is there a difference, or should there be a difference in the way that people think about stranded assets in the fossil fuel industry versus stranded assets in the materials and heavy industry sectors?
Yes, definitely. I think the main difference is in the level of maturity of the alternative, in a way. Like, interestingly, cement doesn't really have an alternative at scale, at the gigaton scale of materials. It just does the job too well and cheaply. Whereas for fossil fuels, if you look at the IEA, WEO, the most recent ones, they're literally telling us, if you invest in new assets for fossil fuel, you will lose some of that money, right? So there's no need for new deployment of fossil fuel assets. I don't think we're there yet for the material industry. We might get there in a few years or in a decade. Like, it's already very earth-shattering in a way that the IEA would say that in 2021. Like, who would have thought 2-3 years ago that they would reach that conclusion? So I think the main difference is that now we know that for fossil fuel, the alternatives are here. You can use renewable for power, hydrogen for a lot of transport. There's still some hard to abate emissions somewhere, but most of the assets, will get stranded, and that's kind of a fact now. For cement, we are inching towards that scenario, given the pace of innovation.
So from the perspective of shareholders, this should be a concern, but not an overriding, and owners and operators, a concern, but not yet an overriding concern until the technologies have advanced to that stage.
Yeah, I think it's not really a matter of whether they should be worried or whether they are worried. I think in a way, all asset owners beyond cement are always worried about that kind of risk, right? It's their job, but it's not about the worry, it's about what they do with the worry, in a way, what this worry translates into, whether it translates into accelerated path to action, or whether it translates into paralysis and continued postponement of the inevitable, which kind of has been the instinctive reaction of most industries in the face of the risk of stranded assets. But I think there's really another way, and I think the cement industry is really well placed to actually take the other roads to fast action, translating that worry into accelerated action.
So how do you see that other road a little bit?
I think it's understanding that in the face of what you said about the competitiveness earlier, it's like the earliest movers in the low cement alternatives will will earn a larger part of the market. And these are relatively stable markets, right? Oligopolistic markets. So it's really hard to gain 5% market share normally in a stable environment. So that creates a huge opportunity for them. And so in a way, they shouldn't look at it in a kind of sunk cost fallacy of, oh, what is the amount of money I'm standing to lose with the stranding of these assets, but rather what's the size of the opportunity I'm standing to gain by investing new capex in a way, renovating, improving on these assets, adding CCS, that kind of things.
So that's an interesting way of thinking about it, which is what's the size of opportunity I can gain based on the investments that I'm making. Do you see indications of any differences around the world in the approach of the cement companies and their willingness to make those kinds of early investments?
Yeah, so interestingly, so I haven't crunched all the data yet, I have to admit, but I find it's interesting that when you look at the places where the assets are the youngest, India, for example, they're also the geographies. It's not about the pace of innovation so much as where the innovation takes place. So in these places where the assets are younger, the incumbents are much more likely and eager to actually innovate themselves. Whereas in places where the assets are older, like the US or Canada, most of the innovation, not most, but I mean a significant part of the innovation takes place in startups outside of the incumbents, and then they have to work with them. Again, like this is not a completely finished point. So I'm happy to be challenged on this. That's what seems to me.
And I'm going to warn everybody, this will be the last question before I look at the chat to turn to some questions. So please put some questions in the chat as you are. So if you look around the world, you see various jurisdictions who are creating some demand incentives. San Francisco and its recent airport project, some of the Nordic countries. How big a role in transformation and creating those investments that we're talking about do you think demand push can have?
So this is demand side is a super interesting point, because I think there's two parts to the answer. First, it's extremely important, and we're realizing that more and more in climate tech, to rely on good narratives. And these kind of spearheading geographies like San Francisco, Sweden, have a big role in creating these narratives for tomorrow and showing the path forward for others to follow. And that cannot be underestimated. Even if it's 0.001% of the market, that still creates the possibility in the mind of followers. So that's one piece. But then in terms of tons and megatons and gigatons of carbon, I think the demand side definitely has a role to play here. But I think it's really more of a production problem first. And in terms of innovation, producers need to take their responsibilities and push the sustainable products to markets, even if the demand seems to be a bit late in materializing itself. I mean, they have the market power. They are in direct control of most of the emissions in the supply chain. So it's first and foremost about their side of the innovation, I think. And the demand side response can be somewhat slower sometimes because it's about behavior change. So it can take decades, whereas like some of the product side innovation is already available, right?
Super. All right, I am going to turn to the chat. And let's see, we have a question here, which is, how can a climate tech startup that requires significant capital for a large-scale pilot structure the business to reduce the investment risk? For example, do they need to have signed offtake contracts for at least part of their production? I'll throw that open to everyone, but I'm going to guess that Eric, you might like to take first stab at that. And Louis, you might want to jump in at that on that as well. Eric, you're on mute. Eric, you're on mute.
Sorry, could you just read the first part of the question again? I got the second half, but the first part wasn't fully clear.
You bet. How can a climate tech startup that requires significant capital for a large-scale pilot structure the business to reduce the investment risk? For example, do they need to have signed offtake contracts for at least part of their production?
Yeah, yeah, that's a good step. You know, that would be a positive thing. The way I've seen that happen in reality is actually through government grant funding mostly. So if you have a pilot project and you in the European Union or the United States or another geography that has interesting incentives for new technology development, if you're able to get that 40 or 50% co-funded, the capital cost of that's a very positive thing. Having an offtake contract is a very positive thing also.
And Louis, any other thoughts on how to de-risk some of these large projects? And you two are on mute.
Yeah, I think the industrial partnerships from the get-go is super important because it's quite hard to build a 50 million plant right from scratch, especially a first of a kind. So having the right partnership in place, we see it a lot in carbon dioxide removal right now, right? Like where firms that don't go for a modular approach right out the bat wants really large pilots, and definitely here the offtake agreements from Stripe and Microsoft help, and then the industrial partnerships with firms like Mitsui, a lot of others are very important in, I guess, de-risking for the first.
Super. Next question. How do you see the flow of climate-focused investment capital into the cement industry and associated projects evolving in terms of emerging versus developed markets? So I guess, where do you see the innovation going first or second? Is it in the developed or the emerging markets?
Yeah,
Eric?
I can, sure. Yeah, I can comment. I think unfortunately the vast majority of venture investment is going into developed markets, and developed markets are only 10% of the world cement demand. I think in the developing world, a lot of the innovation is actually coming from the industrial companies. So in China or to some extent in India, there are really pushes on efficiency and pushes on CO2 reduction that are coming from the industry itself and less from startups or venture backable startups. And I think, yeah, again, the on the philanthropic side, I think probably one of the only projects that's really managed to have an impact and a potentially high impact for the developing world is the LC3 project, because it primarily does target the developing world. It has a center in India, it has a center in Cuba. It's very focused on doing something that's going to be viable in the developing world. But I think that that's key to get more of that innovation, focus on developing world is actually key to decarbonizing the industry, because that's 90% of the area of emissions.
Louis, you made a little bit of a comment about this earlier, relative to the life of the age of the assets and the like. Maybe you want to add in here.
No, I completely agree with Eric. I think it's unfortunate in a way that most innovators focus on the West. Maybe it's a function of the demand hotspots you were talking about, like the American coast in a way, Scandinavia, which just happen to be in the developed world. But we know that most of the impact is going to be in the developing markets, and in a way, the urgency doesn't really allow for these startups to start by creating a profit center in the developed world and then 10, 15 years down the road go into the developing markets. But that might change in the next few years.
Our last question in the chat, which is good timing given our expected end time of 12:15, is climate justice is a theme that has emerged much more strongly over the last 12 to 24 months. To what extent is this a factor in assessing the attractiveness of an investment? Are there investors who are looking for this element in their investments? Francois, I'm sorry that these are more oriented toward Eric and Louis, but you can think of a question that you'd like to answer and I'll go to you.
Maybe just a
Eric,
question
Louis.
before Eric and Louis answer. Are you talking about the social cost of transition? This is a
yes, actually, yes.
Okay.
Yes.
Okay. So I'll let Louis and Eric.
Eric,
actually, I thought there was a question for you, Francois. I thought that there was a.
I think there's a public and a private aspect of this, and the question was asked, I think, more from a private markets perspective, which is, given the prevalence of the theme on environmental and equity, environmental climate justice, are there investors who are looking specifically for investments that include that as an element to their to what they're seeing as their accomplishments?
If I can quickly give the perspective of listed markets, so public equity, effectively, when we started a year and a half ago in Europe, the climate transition benchmark and Paris aligned benchmark, they were solely focused on the overweighting companies which were in under budget towards the, for example, IEA trajectory of a cement industry, and underweighting the companies which were in over budget. So this was a pure perspective of alignment, without taking into account any social impact or even any governance practice within the company. Then it turned out that all index providers and data providers we were working with, upon the demand from the market and the institutional investors, they had to include ESG filters on top of the climate alignment, because we were missing something, in fact. So it's definitely, there is a common layer of prudential attention put onto the social impacts of the strategies, even if now there are new novel ways to build portfolios which are essentially focused on the contribution to the forward-looking carbon emissions to 1.5, for example. So that's just an example of the index business.
And I have a feeling the public markets are leading the private markets in this. I think, and you both, Louis and Eric, can correct me, but that in the private side, people are much more focused on the innovation itself and the financial returns from that innovation, and much less focused on the social impact side and the climate justice side. Sort of accepting that it will be creating climate justice if it is decarbonizing and more clean.
I would differ a little bit with that. So I have seen investors are interested in climate justice and climate equity, but I find myself very surprised to the extent that that is very focused on a particular geography. So investors who are focused on environmental justice in the United States and making decisions on that framework, but leaving out from their calculation that a lot of the technologies that may be come on disuse in the United States then can migrate into the developing world and actually be really problems there. So waste management, for instance, waste and the cement sector are very interrelated, and if you don't allow the burning of waste, or you somehow want that not to happen in your country, it doesn't mean it doesn't get exported to another country and burned somewhere else where the controls are going to be a lot worse, and many more people are going to suffer. So I find that does exist, but I always think it would be better for that to exist within a global framework, and to think about the equity and justice on a global perspective for emissions, for climate, for whatever it is, and not just within a specific geography.
Without a doubt. The decision by China to no longer accept a great deal of the waste that was in fact being exported there was a reflection of that particular inequity, and you see this in so much of Asia, without a doubt. Louis.
Climate justice is definitely something that we look at in every, I guess, due diligence. At SYSTEMIQ, we try to take a systems change view of everything, including innovation. I would say that, I guess, on a global and geopolitical scale, climate justice is very hard to measure, or especially to project, like based on an early stage innovation. I'm very excited, actually, ahead of COP26 to see what progress they make on these issues of climate justice, because I think a significant part of the climate movement really believes that there will be no climate transition if it isn't a just transition, and I tend to agree with that, because like the major markets need to feel that it's a fair deal for them, right? So India, China in particular. But we sometimes it's more of a local climate justice piece, looking at the local market, but whenever we can, we do include it.
Well, it's interesting. I mean, the recently announced methane fund, funded by a great deal of philanthropic money and sponsored by the UK and the US and a number of other countries that have signed on, is really focused in this area, right? It's eliminate those methane emissions, but provide financing behind it so that in the developing world, there are funds available and technical assistance available to accomplish that goal. Well, I want to thank everybody for participating in the panel, for sharing some really interesting thoughts, and thank everybody who was watching. This has been a great pleasure, and it is now 12:16, so I understand that we should be wrapping up. Would any of you like to add any final thoughts?
Thanks, Julie. Thanks, everyone.
You're very welcome.
you.
You're very welcome. Great. With that, we'll look to end the live stream.